Well, I guess to really kick things off, first of all, thank you for coming here, Jonathan. I appreciate it.
Thanks for having me.
Of course,
Amazing
absolutely.
podcast studio.
Yeah. It's we got the good lighting, we got some good gear. We're ready to
It
go.
beats my I did the podcast in the office last week and literal jackhammers right outside the window.
Hey,
So
these are soundproofed.
I could tell. It's peaceful.
So we won't have to worry about that. But maybe to start things off, I think a interesting place to start would be to not start with the founding story of OpenYield, but maybe start off where you began your career. Was it at Morgan Stanley? Am I remembering that correctly?
Yeah. Started my career at Morgan Stanley. Even rewinding a little bit more, I was at MIT undergrad, studied computer science and finance. And, there's a boom on Wall Street while I was an undergrad. So, first summer internship actually was between semesters at MIT. I interned in investment banking and got a taste for the pace of investment banking. Quickly realized it wasn't for me. So my next internship, I really wanted to check out sales and trading. So I did that as a summer analyst between.
And was this pre or post financial crisis?
This was the summer of 2007.
Okay.
So it was a boom.
Yeah.
There was a sign on the Morgan Stanley trading floor when you left that said, "Did you make money today?"
Yeah.
When the crisis happened, they took down that sign.
It
was too depressing. But I had a blast that summer, got an offer, and had a blast senior year and went back and started my career as an analyst as part of the fixed income program at Morgan Stanley.
When you think back to that time and kind of contrast it to where markets are, and we'll start to talk more about OpenYield, but what do you think has changed, especially within fixed income trading over the past 15 years or so?
So when I landed on the desk, so this was 2008, Morgan Stanley is a massive trading floor in the middle of Times Square. It's like a square city block. You had all sorts of different products next to each other interacting. You had an FX desk adjacent to emerging markets where I started, and you had spot FX traders and salespeople yelling throughout the day. And I would get in the morning as, the bottom of the totem pole at 6 a.m. on the EM desk, and I would hear over the squawk brokers in London just repeatedly quoting where the Aussie dollar was, where dollar yen was, just shouting at it. And, I could even tell, I was like, this is kind of crazy that this is how things work. Because a lot of technology was happening outside of fixed, just in the general world as a consumer. Like Facebook was out. I remember when the news feed started. And on the trading floor, we still had a lot of these legacy processes of people communicating by shouting. And, one of the things that I spent a lot of time thinking about earlier on was it would be great if we just had systems to connect all the data that the trading floor was experiencing to help people be more efficient with their jobs. And so I always had this interest in building out products and technology to facilitate more efficient capital markets. And this product at Morgan Stanley is called SalesLink.
And was that a Morgan Stanley created product, or was it built on top of like TradeWeb or Market Access?
It was completely internal to Morgan Stanley. It was like born in my frustration as a trader and my peers, where every single time we had an axe and needed to buy or sell something, I would have to pull together data and kind of present it to a salesperson or somebody else and say, here's all the things that happen. This is why you should call this client.
Yeah.
And so the idea is like we should just have systems that take data to automate and optimize. And so it's very clear that there are all sorts of ways that, existing technology could help the business. But just broadly looking around the trading floor, you had a lot of traditional yelling to communicate, going back and forth. A lot of fixed income was, it's called a voice-driven business. And even going over Bloomberg and chatting, that's still considered voice trading because you'd have a ton of Bloomberg chats and you chat with everybody. And we saw the earliest inklings at that time of electronic trading too. I would get pop-up tickets on my computer from the various ECNs or, Bloomberg AllQ, RFQ platforms. And, I'd click accept, and, trades would go through. They'd be pretty small, but over the years, they kind of grew. And so one of the things that we always watched was what % of volumes are happening over these platforms versus voice. And I thought in 2008 and 2009, maybe in a year or two, it's going to be 100% electronic, and this will all go away.
Because that's what was happening in equities, right? Like people were consolidated into automated trading.
Yeah, and very fast-moving markets, are usually lend themselves to automation the soonest. But I had a lack of appreciation for, the paths of institutional change. Like what actually truly changes things, because you have, tens of thousands of people at different organizations where the vast majority are pretty reluctant to change anything. They have great jobs.
Yeah.
They have great relationships. A lot of the business was about worrying about being disintermediated. Like,
Yeah.
oh, that's my client, and now I'm going to bring them with me over here. Or you have to trade with me, and then I could charge you X, Y, and Z. It's a totally different philosophy of let's just connect people and have people trade cheaply.
Yeah.
It was all about, preserving relationships, monetizing relationships. That was a large part of the business.
Yep. Was there a moment when you kind of in maybe the younger years, the analyst years, where you had that aha moment of, oh man, my MD's job is to make sure that XYZ client always comes to us? That it wasn't necessarily about let's make it more efficient of a process.
I had a realization, relatively early on in my career that I looked around the trading floor and I saw the more senior people and what they were doing and the satisfaction with their careers. And by and large, I didn't really identify and say like that's what I want to be doing 10 to 20 years from now.
Yeah.
I was always thinking about how could I take the skill set that I'm learning and do something more. And I've always had this entrepreneurial flair. So it's always been my how do I eventually get to the stage of founding my own company? But the path to get there is completely unclear. And to be fair, I really didn't think too much about it during most of my 20s because the career was really great.
Yeah.
You get into these roles after college, and if you're succeeding, get paid really great. You really enjoy it. You're not really forced to be like, okay, what's next?
Yep.
And for me, the first transition point in my career came after I went to Columbia Business School as part of the executive program. I graduated. It was really surprisingly intellectually stimulating. And coming back to the job, I was like, I'm ready for my next thing after that.
Yep. So you had that kind of inflection point in your career. So, well, let's talk about OpenYield. What was the founding moment? So your post Columbia Business School, you also went on to Domain Money as well. So take us from here to there, and as well as tell us the founding story of OpenYield.
Yeah, so there were a couple of quick stops after Morgan Stanley, but before OpenYield, I tried my hand at a few very early stage ideas after Morgan Stanley, and then joined Bridgewater. Actually, it was a really interesting role to run the fixed income execution trading desk, and that was like a completely different perspective on the market for Morgan Stanley.
Yeah.
So I was there for under 2 years, and then again very interested in fintech. Spent time at SoFi and then Domain Money building out retail brokerage offerings. Domain was very crypto exposed. We pivoted the company. I left, and I was thinking through what I wanted to do next. And I was really thinking a lot about the fixed income markets where I spent most of my career. And I had this unique perspective from being on the sell side, being on the buy side, and then also understanding what's happening with fintechs, building out retail brokerages and advisory platforms, and formulate the thesis that I thought there was actually a very timely opportunity to launch a bond marketplace focused on this segment.
What underpinned that thesis? Like, was it you having conversations with all the players in the market, seeing the shift of, or the amount of power that's aggregated by RIAs, as well as the coming kind of wealth transfer? Or was it saying, hey, now there's additional infrastructure that makes it easier for me to plug into these end distribution points? Kind of what was that core insight? Was it more qualitatively driven or more quantitatively driven?
Both. It was a confluence of, I like to point to 3 crucial catalysts in the market that allowed me to kind of establish like why now was the right time to take the bet. And the first is that interest rates weren't zero anymore. Like if you really look at it, we had a decade where interest rates were zero. It really made no sense to buy bonds for yield. Like why would you do that? That was really distortion of where fixed fair values for fixing markets. And now we're back in a more normal time where there's yield. So demand and appetite for yield had returned, which in and of itself isn't the sole thing, but it allows you to have lots of conversations with organizations who now want to build.
And it drives retail investor interests who are incredibly yield focused or just absolute return focused.
100%. A really important catalyst outside that macro catalyst is where the ball was in terms of the investment in automation for market makers. And this is really crucial to the story because if you go back in time 10 years ago, and even if yields weren't zero and you really wanted to build an equity-like marketplace, it would have been really hard because the liquidity provision wasn't there.
Mm-hmm.
And so investment in the credit space really started around the time I left Morgan Stanley around 2015 and 16 to start building out, the algos. And these have gotten much better with time. And I would hear from my peers in the market who I'd periodically catch up with, algos can now quote 500 bonds, two side. Algos can now do 2,000 in the IG space, 500K up. Hey, that algo at that bank can now do 10,000 bonds. So I saw how this was progressing. And then the third change was all the new infrastructure that's being developed to support retail brokerage businesses, wealth management businesses. They're entering the market, and the surface area for them to get into the bond market is this legacy stack that would be tougher for them to play with. So I saw a distinct opportunity to get a toehold with a lot of these new players in the market to build a modern, forward-thinking offer.
Part of what your job is to make fixed income investing cool and accessible to people, where they're like, hey, should I invest, X amount of dollars, $1,000 into Microsoft, or should I invest $1,000 into whatever Microsoft's available paper is at any given point in time? And that's also one thing that when I was kind of prepping for this interview, like I've actually never truly thought about, hey, should I invest in IG credit? I honestly don't even know where to find that paper, at least through like my brokerages, which are largely Vanguard and Robinhood.
Yeah.
And then even here at work, I'm like, well, I have Cap IQ. Presumably, I should be able to find it, but I'm like, too much friction. Don't care.
There's definitely a lot of confusion around access and product delivery, that there's a lot of efforts in the market to now bridge the gap. So to take a step back, the way I like to think about this high level is now every single investor has some type of like target portfolio allocation.
Yep.
Like classically, it's like 60-40 equities bonds, but now it's more complicated with like crypto and alternates. But there's a real sleeve there for fixed income.
Yeah.
So then the next logical question is, how do I gain exposure to that sleeve?
Yep.
And so you have a short menu of options. Like traditionally, it was you buy a mutual fund. Now, in the last 10 to 15 years, ETFs have been developed that make it even easier. So you don't even need to buy a mutual fund. You buy an ETF. You could trade them. The product that's playing out most rapidly now is the rise of SMAs, separately managed accounts. So the same asset managers who have issued mutual funds and ETFs are now building out systems to allow individuals to buy, their own portfolio bonds and have it be managed. And the advantage there is they're customizable and more tax efficient.
Mm-hmm. But are SMAs largely distributed through wealth managers, or or individual retail has access to SMA?
It's distributed through advisory platforms and directly through the asset manager themselves. So there's a third-party channel and there's a direct channel. But if you think about as a retail investor, like how you're going to invest, there's the do-it-yourself option, which for the most part, people usually have a small pocket and it's more for like gambling or speculation and mess around. And whenever they have like enough wealth, they say, okay, I'm going to hand it off to somebody else and like let them deal with it. Yeah. So a lot of retail investing is really done by an advisor on behalf of like the end customer. And so there's some advisors who will buy bonds for you and they specialize that and they have a platform and they might be very good at it. And there's some who'll, toss the keys to an asset manager and say, okay, I'm going to put you into, an SMA managed by, name your favorite asset manager. So both those are very popular. The way I think about how we're enabling this ecosystem is we're building a marketplace to make it cheap and easy for anybody to buy and sell bonds. Mm-hmm. And at a certain level, we're somewhat agnostic between who's doing it, whether you're doing it yourself through the brokerages you mentioned, or it's your advisor doing it, or the asset manager doing it. Because no matter what, those bonds need to get traded. And the best place to trade them is through a venue and a system that provides them the fastest, best, cheapest liquidity.
Yeah.
And so that's what we're just laser focused on building out and making it as easy as possible for any of those end participants to get that liquidity. Now, though, you contrasted it to stock for Microsoft. There's been such a significant investment in the end retail experience to trade equities. There's platforms everywhere. Data is ubiquitous. Analytics is ubiquitous. In fixed income, that's not the case at all. Like it would be hard for you to just like go on the internet and find the price of that Microsoft bond or even see what's called reference data, which is the basic facts of the bond. What's the maturity? What's the coupon rate? And if you do, there's not that many sites that have it.
Does that data get originated by obviously it originates with Microsoft at some point, but who like really warehouses and aggregates all of that reference data?
The large data providers out there, Refinitiv, ICE, there's a bunch of them, but it comes from the filings.
Yeah.
If you go to the SEC aggregate database, like you could pull the document for that bond and you could see it on there. And so to create reference data, you basically have to scrape these documents, and there's some structure for them, but a lot of it's unstructured, especially in the muni market, and structure it into a database and then make that available. And there's fees involved with that. What's really interesting there though is, these very large data providers, they have teams of people overseas who key in stuff from documents, and they have like a double, triple check system that then gets into their database
It's
that
still
now
wrong.
AI could do.
Yeah, but it's also
And it
probably
creates
still wrong.
mistakes. It
Yeah.
creates mistakes. So there's like a real nice tailwind here of AI massively changing the costs of originating this data and maintaining it. So we're really excited about that trend. But just like any of these, mega trends, what we're doing as a marketplace is we're making liquidity easily available. And ultimately, as the market becomes electronic, you're going to be able to create tons of products on top of this liquidity that makes it incredibly easy for end investors like yourself to go to your brokerage,
Mhm.
go to Robinhood, and click a button and say, I want to invest for 2 years in high grade paper.
Yep.
And you click a button, and it's originated. Public has been out there kind of pushing the envelope here with their bond account. And that's basically what they did. It's like a great proof of concept where you could click, I want a bond account. They have a portfolio of bonds. You click, okay, I want to buy them. And there you go. Now, there's all sorts of white space around that to help customize and make tax efficient,
Yeah.
introduce munis, and all the brokerages are going to do that.
Mhm.
But we're at the earliest stages of that beginning to happen.
Yeah. So if we think about, call it the hero's journey, call it the startup journey, what would you succinctly describe the mission of OpenYield as, right? If you're talking to the 20-year-old version of yourself, fresh out of MIT, and they still may have that option, right? Hey, you want to go trade derivatives or emerging market credit at Morgan Stanley, or do you want to come join OpenYield? Like, what are you telling that person?
Yeah, there's a couple of angles there. Like I now like to say we're disrupting the bond market.
Mhm.
We're taking a lot of the existing structures, and through a combination of technology and partnerships, we are creating a better, faster, cheaper way to access the bond market and try to do it as the lowest cost with as much automation as possible.
Yeah.
Like there was a time where I think automation was a bad word, and
Mhm.
it was a threat. And it meant that, you're not doing your job anymore because like you would take this and put it here and you'd do this all day and you'd make money and you'd have a P&L. And like we have a pretty simple philosophy. We want to automate as much as we can and
Mhm.
leverage technology as much as we can, because that means in return we could provide an experience that's extremely low cost
Mhm.
and makes it much easier for participants across the board to access the bond market. And it could be direct through a brokerage, or it could be indirect through various ways to have portfolios manufactured for you. And so, we're obsessed about the cost structure of this industry and figuring out ways that we could eliminate costs.
Where have you kind of recruited people to start the business? Is it from prior companies or just going out into the market?
The first a combination, but the first and most critical recruitment was when I hatched the thesis and needed to find a co-founder
Mhm.
who would credibly be able to build the platform. I just started talking to as many people in the market as possible, saying, "Now, I'm going to build OpenYield. I'm looking for a technical co-founder. Do you know anybody?" And I
Yeah.
was very fortunate to ultimately have been introduced to Hilton, who's like the perfect co-founder because he knew exactly what I was talking about and how to build it. Recruited the first employee from my former employer,
Mhm.
Domain Money. That's Alan Reed. And then, the rest of the staff, like, we posted JDs out there, there were referrals. One of the more recent joiners emailed me direct and who's in the market, he's in the muni market, and he said, I absolutely love what you guys are doing or you're
Yeah.
hiring. And it was serendipitous because we were
Yeah.
actually looking for somebody with this exact background.
Yeah.
And so that's when Eric joined us.
Yeah. One, in a lot of these interviews I've done just over the past few years, serendipity is something that always comes up. Even as investors, we talk about it, how sometimes you just got to go out there and be out in the market, see what happens, and you're going to have that serendipity. So I'm curious about how you could call it serendipity, you could call it luck, how that's played a role or factor in your careers, where maybe you went to an event or maybe you went to an office hours or whatever and actually had a market impact on your life and the decisions you've made.
I don't have a case ready to pull out my pocket and be like, that was serendipity. I think just broadly speaking, it's absolutely everywhere. Like there's so many elements of talking to the right person and having them at the same time have, in markets we're fixing when you say have the acts, like have
Yeah.
the want to do the thing that you're asking them to do
Mhm.
to make something happen. Like as a founder, especially early stage, you're basically in the business of just like trying to get in front of as many people, asking them for feedback, to use your product, to join your team,
Mhm.
to reduce your contract cost. Like you're always just trying to get in front of people, and you're asking, and you kind of realize that the people who actually you end up transacting with are the people who already really wanted to do that kind of business to
Yep.
begin with. And the other people will politely listen. They'll shake hands with you at a conference. I like to say they blow smoke up your ass because, like, then you go back to them, like, are we going to do business? And it's like, yeah, this quarter, maybe
yeah.
next quarter. And, like, there's so much of that. So it's every single time you're actually able to get in front of somebody who has the opposite need. Like, that's serendipity.
Yeah.
Like, because they don't wear it as a sign. Everybody has a sign in front of them that, like, they're head of innovation this, or like,
Yeah.
I'm going to e-markets that. It doesn't mean it's going to result in any collaborative behavior. They could be like, somebody's job title could be like, I want to partner with like innovative bond marketplaces. And I could be like, hi, we're an innovative bond marketplace. And it'll be like, there's nothing to do. It's like, because like you're not actually in a position to do anything.
Yeah. Yeah.
So much serendipity. And that's why like the common sense thing you can do as a founder is maximize your surface area to that kind of stuff. Like take a lot of meetings, send out lots of emails. Don't be shy. And the good things then start to come back. Like one of my favorite examples here is like we've had a terrific partnership with TD Automated Trading. Terrific. And then I sometimes get asked like, oh, how'd you get introduced to like, Marty Mannion over there? Like, I love Marty. He's great in the market. I had emailed the contact form on his old firm saying like, I'm building a bond marketplace. Could we have a conversation about providing liquidity? And it went to his email, and it was completely cold.
Yeah.
So, I used to spend a lot of time trying to maneuver to find like intros to the right person, but like, reaching out to the person who actually has an aligned view for what you want to do works.
Yeah. And it's kind of counterintuitive where it's like, should I like have the best intro path in the world, or should I just send the cold email? And you kind of compare it to like golf as an activity where you're like thinking about, hey, like what's my approach and should I do it? Like, no, just go up and hit the ball. See what happens.
What I found is you do both.
Yeah.
There's no like rules of the game here. Like you should be polite. You should have common sense on how to not be annoying.
Yeah.
But like it's free and takes like 30 seconds to rattle off a message.
Yep.
And then ask somebody else, like, by the way, like I'm trying to get this person's attention if you need an introduction.
And lots of people's lives depend on them checking email diligently.
Totally. And I'd say there's a caveat here, which is you'll speak to people who will say like, I got this huge Rolodex. I could be like extraordinarily helpful for that. In the beginning, I was like, oh, well, this guy's a big Rolodex. Like that could be really helpful.
Yeah.
And I almost write that down to 0 today.
Yeah.
I was like, it doesn't
if
really
someone
matter.
Leads with saying, hey, I've got this huge Rolodex. Yeah.
Like the Rolodex really doesn't matter because like at the end of the day, the people at the end of the Rolodex need to, again, have this axe.
Yeah.
And you could probably get to them if they have it.
Yeah. And it's also, to use your terminology, the axe changes at points in time, right? Like there's probably, you largely sell it. Who are the people you sell into today?
It's completely a temporal thing. Like you got to catch them at the right time because people have a lot of stuff going on. And, when you think about like who are our buyers of OpenYield, it depends on, the segment. But, if you're a retail brokerage, they usually have professionals who are in charge of, fixing them liquidity expansion and technology. So like that's who we talk to. If we're speaking to an asset manager, we're speaking to portfolio managers because they divert resources. If we're speaking to the sell side, it's a combination of, desk head and usually they have support through like an e-markets type specialist. But there's all sorts of different sellers out there depending on the organization. And it's also different from, who the champion is going to be because the champion is not necessarily the decider. And so, you have to have this framework of, okay, who's going to, push it internally? How do we give that person what they need to support the business case? And it really varies like how you get that in front of people. And so one of the things that we've learned that's just critically important and a no regrets type of thing is, we want to make a lot of noise. So I'm here doing a podcast. Like we want to produce content. I think we have a decent amount to say about the market, and we're at this unique position where we could bring together all sorts of disparate participants
Yeah.
and put things out there. So, our head of business development, Mark, started a podcast last month too.
Yep. And he interviewed the TD guys, right?
Yeah, that
Yeah.
was the first one, and we just dropped the second one today. And I'd be remiss not to mention, we recruited Mark because I'd worked with him at Morgan Stanley too, and I went to business school with him.
Yeah.
So the people earliest in your journey are going to be the people who usually know you and have a relationship with you.
Yep.
And if you can't get them to potentially join your firm or use your product, it's going to be harder with strangers.
Yep. You can't skip trust as a vector.
Yeah.
So let me ask you this question: what do people not understand about bond markets generally? Again, and also when you think about the incremental demand that's going to be coming on to or using OpenYield's infrastructure, right? They may never interact with you directly, but through their broker or on their sell side desk. Is the incremental demand coming from institutions who want better pricing, more transparency, better speed, or is the incremental demand coming from retail, or is it a combination of both?
It's both. The fixed income markets in aggregate, continue to rise.
Yep.
There's always going to be more issuers issuing more debt, governments issuing more debt, for better, for worse.
Yep.
And so I view the world you have the existing flows of participants, asset managers, et cetera, that we want to be a part of and help improve. And then you have this objective of originating new business and bringing on new brokerages for the first time. And, the international opportunity here is huge too.
Mm-hmm.
There's tons of demand to hold yield-bearing dollar assets. The dollar is still, as of right now, the reserve currency of the world. And so, people want to earn yield now that there's a world with yield. And so, given what the distribution networks are domestically, you could just imagine, the cost structures involved internationally.
Yep.
Or, take some person in APAC and have them buy, a T-bill.
Yep.
And what's the aggregate markup going to be? It's just data. It's just a database getting updated. There doesn't need to be that many markups. And so we're excited about, all that connectivity. And the first part of your question is what do people not know about fixed income?
Yeah.
It's surprisingly intimidating. The bond market, how does it work? How's it all connected? And people often think that equities are pretty simplistic. They're like, oh, it trades on exchange, I see a price. But
they feel tangible, right? I'm buying a share of Microsoft.
Correct. I'm buying a share of Microsoft. But and that experience feels easy, and they mistake that experience for thinking everything's just traded on a central exchange, when the reality is you have this whole vast fragmented network of ATSs and exchange and wholesalers that are really on the other side of your order flow. It's just been wired together in such a proficient way that it feels like it's being solved by a single centralized venue. And so that centralization, I think, is often misstated. And the fixed income market's also clearly not centralized. It's an OTC market. There's not an exchange. But there are venues that do coalesce liquidity. There are platforms that coalesce liquidity. So the transacting experience, as far as it goes on OpenYield, looks and feels just like it does on an equity marketplace. You have limit orders, you have market orders, instant fills, you're executing off top of the book. But I think the gaps are more around what you mentioned before with the Microsoft bond. What are you even supposed to buy?
Yeah.
How do you get involved and structure a portfolio, even if you had all these instruments available? And I think it's naive to assume that, retail is going to become, a fixed income portfolio manager. It doesn't make sense. There's actually a lot of complexity as you try to get more and more sophisticated. But there's not a lot of complexity in putting in some basic goals and having your brokerage or advisor generate a bond ladder for you and earning yield. And that's actually a very efficient product for earning yield. And so that's a layer that really needs to get resolved before there's more participation.
And this is one market question. Again, I should have looked this up. Where does even AAA rated paper, what does it yield today?
You're hitting me on the spot, but AAA rated paper in corporates means that it trades at a very small spread to treasuries.
Treasuries, yeah.
So you could take the U.S. Treasury curve, where most bonds are 4.5% roughly, and you add some spread on top of that. The most AAA is extremely rare. The United States isn't even AAA, but you have Johnson & Johnson, which was the first bond that traded on our platform. The trader made a joke that I only want AAA. And so it'll trade at a small spread, less than, I don't know, 50 basis points sometimes.
Yeah. But the reason why I bring this up, and it's educational for me, is like, even if I think about, the next class, there's like double B rate, or like goes to double A, but then triple B, double B, etc.
Yeah.
Even in that like kind of lower segment of the B rated bonds, like presumably it's still not as much risk as investing in equities, right? You're investing in a bond.
Yeah, you're making a great point. And I love just calling out always you're more senior in the capital structure when you hold fixed income. So what that means is when companies issue equity, common equity is the last to get paid out in the event of a bankruptcy. Every time you issue a bond, you're senior to equity. So if Microsoft went bankrupt, which would be a very long time before that ever happens, what usually happens if you hold equity that gets zeroed out,
Mm-hmm.
and if you hold bonds, then you have a claim on the assets.
Yeah.
If you look at the data, if you look at investment grade paper, like the preponderance of defaults, it is so little. It's less than 1% a year.
Yeah.
It's less than 0.5% a year. And when that happens, it's not like it goes to zero, like what usually happens with equities. There's usually a pretty significant recovery because the company usually has assets if it's in the market issuing investment grade bonds. So recoveries are usually, well north of 60%. When you factor in the things, it's like for you to buy investment grade paper and lose money holding to maturity, it's actually really hard to do.
Yeah.
And you don't need to diversify yourselves that much. Consequently, you don't need to hold like thousands of bonds to get an index type return, because in bonds, you're worried about downside. There's limited upside. It's just getting your, full proceeds back. Whereas with equities, you actually need to hold all these different underliers because the index return is driven from the very few, very, very few.
Yeah.
Like if you don't hold Amazon and you tried to replicate the NASDAQ, you would have missed out on a lot of return. And then NVIDIA last year. So trying to replicate, getting an index with equities is actually really complicated. You have to hold lots of stuff. The tax loss harvest is more complicated. But you could hold a bond portfolio and actually very easily beat some index by holding higher yielding bonds.
Yeah. And then if I think of, let's say the average return of the S&P or the NASDAQ over the past 20, 30 years is roughly 6 to 8%, right? Going back to your point of, hey, yields have risen now above zero.
Yeah.
But there's certainly triple B or double B paper that's right around 6 or 7%. And you're locking that in.
The last page of my very first pitch deck for OpenYield was a quote by Howard Marks. He came out with a paper called Sea Change in December of 2022. And he said, now that credit has normalized, he's like, you could earn equity-like returns by owning credit. And I see no reason to take the risk of owning equities.
Yeah.
Title says it all. It's a sea change. You can really rethink, like, what's your risk and return? And if you could earn high single-digit %, the bond portfolio, which is stable income, you're senior in the capital structure. I have some friends on a text thread yesterday because of this recent market volatility being like, what's going on? And I was just joking around like, I suggest you guys consider bonds for the stability. And now it spurred this whole conversation, just like what you said, like, how do I buy bonds? Like, should I buy an ETF? Like this and that. And, I'll go through my spiel, but the access points, there's a lot to be done.
Yeah. I think one of the questions I would be curious to ask you is, do you think there's a cultural change within again, I'm speaking on the retail investing side, but do you think there's a cultural change that's needed to help retail investors think more actively about like, hey, why am I just fully levered to like 7 companies right now? Like maybe I'm a little uncomfortable with that. Do you think that's a cultural change, or do you think that's needed, or do you think OpenYield can kind of manufacture that by having these conversations actively and in the market and in a ton of different places?
We're not trying to directly impact or change retail perception of fixed income at this juncture.
Yeah.
We're just very focused on being this horizontal layer for the brokerages that retail is connected to, or their advisory platforms, to enable them to offer a much better product experience.
Yeah.
Retail itself, it's a great question because I've been following the story very closely. When I was at SoFi, that's when the GameStop thing happened, and with the zeitgeist of retail investing and Reddit and Wall Street bets, and
look,
whatever.
you can even the amount of trading volume done by retail from 2019 to 2020. I don't have the numbers off the top of my head, but there's just a clear and marked increase that has been sustained as well, which I find pretty fascinating.
So the products that have by far the most retail adoption and the most focus by platforms servicing retail, who are highly commercial, are focusing on highly leveraged instruments.
Yeah.
So if you look at everybody's roadmap in the brokerage industry going back several years ago, like everyone's like, we got to get options.
Yeah.
We got to get margin. We got to get options. Oh, we got to get futures. We got to get 0-day options.
Yeah.
These are the most how like they're not investing products.
Yeah.
Like it's really gambling. And then when crypto was banging off, like, oh, we got to get crypto, we got to add Dogecoin now.
Yeah.
So there's this element of like mixing together like speculation trading and then investing, and like bonds for the most part, it's more of in the investing category for like your real adult money, not like where you're pulling out your app to speculate. We do think we could help enable a real speculative market for like high yield corporates and like special situations. Like that stuff could be really interesting.
Yeah.
Like the best crypto yield in the world going back a couple years ago were like Coinbase bonds. Like they were yielding in like high double digits. Like you didn't need to do any sort of stable coin play. Like just buy that.
Yeah.
But retail, like they weren't talking about bonds.
But again, I'm here thinking like, damn, why didn't I think of that? Like that's great. Because I don't know, I just don't think it's super top of mind. I want to read off a stat to you that I thought was fascinating. So in 2023, U.S. equity issuance across IPOs, secondaries, and preferred was 139 billion. U.S. fixed income issuance across treasuries, MBS, corporates, munis, agency, and ABS, 8.3 trillion.
Yeah.
And I process that information, and it kind of boggles the mind in terms of just how much larger the market is on the fixed income side. But then here I am thinking like, oh, I've never thought about, I could own Coinbase's paper. And like, what is driving that kind of asymmetry? So I'm just curious about your reaction to that data point.
Yeah, I think, fixed income captures a lot of different product segments as like a catch-all term. But if you're just thinking about capital markets, which involves like trading all financial products, you have common equity, you have preferred, you have convertibles, fixed income, you have government debt, you have municipal debt, you have corporate debt, you have international EM debt. Then you also have mortgage-backed securities. Obviously, the mortgage market is absolutely massive. You have agencies. So you have a lot of different categories within fixed income. As a side point, like fixed income also means it matures. So there's always the cycle of maturity, reissuance, maturity, reissuance. So, the net number is going to be below that 8-something trillion, but it's big. And this, if you think about how institutions invest, like equities is a more of a speculative sleeve for stable institutions who aren't focused on growth, who want capital preservation and income.
New York Life wants to know their money's coming back.
Yeah, and so a lot of the, think about asset liabilities, you have, pensions and insurance providers where they're just, they're soaking up fixed income paper because that's what they need.
Yeah.
That's what matches their investment mandate. The latest greatest thinking by portfolio allocators to think through what do people need throughout their life cycle of investing. You have some type of curve that says individuals should, in the beginnings of their career own less fixed income. You want growth. But as you get closer and closer to retirement, you want more and more fixed income because you care more about that stability. And that's a worthwhile trade-off. And we're living longer.
Yep.
We're retiring later.
Yep.
And there's just going to be more and more appetite for fixed income. So, I think the whole story of like, how do we take all these securities, package them up efficiently, and deliver them to that investor is something that, we're super interested in. And ultimately, all that 8-something trillion, it might be owned by institutions, but it's people underneath it that have that claim. Like institutions aren't alive; like they're stakeholders. So yeah, it's interesting it's really interesting to think about, and people don't realize just how large and important the market ultimately is.
Yeah. What's the thing you want people to understand about OpenYield at this current point in time? Like you've got the microphone, you've got the stage. Like, what's the one thing you want people to take away from this conversation?
We're in the market with a terrific product. We're live with corporates, munis, and treasuries. The liquidity is great. The technology is great. And we're speaking to firms across all these different types of segments of participation, the retail brokerages, the advisory platforms, the asset managers. We're focused on one thing right now, which is growing the participation on the platform. For us, it's really important to get our name out there.
Mm-hmm.
I hear there's like a Muni conference 2 weeks ago in California where, a big asset manager who we're speaking with, gave us a plug. He's like, hey, by the way, a lot of people might reach out to you because they've never heard of you.
Yeah.
I'm doing these podcasts. I'm posting on LinkedIn. How have they never heard?
Yeah.
There's a big world out there,
Yeah.
and so we're trying to figure out how we could, leverage the limited resources we have to get our name out there,
Yeah.
and sign people up. So we're here, we're live, and we'd love to talk to anybody in the market who's interested in joining the marketplace.
Yeah, totally. One of the things that I love about the tech industry, entrepreneurial industry, is that, I think there's a default toward giving back and sharing the lessons you're learning along the way. So I'm curious in terms of, your experience as an entrepreneur thus far. What was one of the expectations that you've had that maybe didn't match the reality that you're experiencing kind of day to day?
Yeah. So my first foray into trying to do something was back in 2016 after I left Morgan Stanley. I worked on 2 projects. One was this play to allow apartment owners in New York share equity upside with investors. Another was a way to leverage Plaid to allow friends to share credit card transactions with their friends. I just had this bug where I want to build something.
Mm-hmm.
Now I'm reading the forums. I'm seeing YC videos. I'm like, I want to start a company.
Yeah. I can do that. I want to do that.
I had no idea what I was doing.
Yeah.
My partners had no idea. We were just figuring things out. And sometimes that works.
Yeah.
But I learned so much more after that. The experience of being at SoFi and that's really, it was an entrepreneurial organization, but a later stage, and then Domain where I got to work with Adam Dell at the earliest stages and really be helping drive things for the first time with an organization under me. I soaked in and learned a lot. So I think it's tough to dismiss that learning experience of understanding how different organizations work, how to actually get stuff done.
Yeah.
And so when I took the plunge and started OpenYield, I kind of knew how to start an organization at that point. You don't know a lot of things, but how to quickly figure out and make decisions and keep going and recruit people and keep going.
Can you just double click on the keep going part? That there's a lot of persistence that's required in a role like yours.
Yeah. I love the quote. The most important thing is not forget the most important thing is the most important thing.
Yeah.
And so, Adam Dell used to like saying startups don't lose for lack of ambition. It's lack of focus.
Yeah.
And you really got to focus on the thing is that you're building, because every time you have a lot of these conversations, you get, you learn about, you get pulled in this direction. But you can't just be clay and you got to actually think about, where you're going and carry a vision and not be stubborn about it, and striking that balance between being an ideologue and being incredibly open-minded to feedback. I find that to be the most important thing, because we have a vision, but we have to be really practical too as we execute on the vision. Does that answer the question?
That fully answers it for me. The comment I was going to make is that you might be ahead of the market, which is why you need to be open toward that feedback.
Completely. Reflecting a lot, thinking does this actually change our thinking as things come out? Are you carrying the vision? Yeah, everything that we've learned so far on this journey has actually been supportive of the thesis. And, I like to say, my confidence has never been higher in the thing that we're doing. In the very beginning, it'd be great if we had a better bond marketplace.
Yeah.
Wouldn't it be cool if bonds trade like equities? Let's just do it. But I before starting, I was really cautious, because I had been at Morgan Stanley turning away marketplaces from coming to us and be like, let's trade with Morgan Stanley. I'd be like, we don't care. We'll listen to you when our clients tell us to sign up.
Yeah.
And then I was at Bridgewater, where we're really focused about using technology to improve trading, and a platform had come in and they want us to adopt it and potentially invest in them. And I brought it to a decision committee, and colleagues were like, we have these clear ROI projects that we need to invest in. Why would we spend time on this where it's a gamble?
Yeah.
And I couldn't get it done.
Yeah.
And so I had so much skepticism around what it would take. And to me, that was also part of the opportunity.
Yeah.
There's been a lot of scorned entrants to the space. So there's been a lot of discouragement, but we had the thesis, we built, and we keep talking about it and getting feedback. And, there's a there.
Yep.
And we're executing.
And you're going after it. On another angle of feedback, you've raised a $7 million, I think, seed round from Canopy, Fin, Clock Tower, and TD as well. So a great panel of fintech-focused funds. Coming back to my comment of, sharing what you learn as you go along the way, Can you talk a little bit about what worked in that fundraise, what didn't work, what you learned, mostly in the context of speaking to other kind of fintech entrepreneurs that may be coming up behind you?
Yeah, sure. So that 7 million number is an aggregate from a pre-seed round and then a separate seed round with Canopy. Raising capital is so hard. Everyone's distorted by the bias of seeing the announcements of fundraisers. They don't realize like the path it took for those founders to get there, get it over the line, sign the
Yeah.
term sheet, have the cash hit the bank,
Yeah.
etc. You got to be able to concisely tell your story.
Yep.
What is a thing you are building? How is this helping solve a problem? I used to get so irked talking to folks called crypto founders, especially who were building something, and especially being a domain where we were trying to solve something crypto. I was like, what is the problem that you're trying to solve? And they're like, well, if somebody uses this, and then if they like this, and if they like this, then maybe this product. I was like, it's too contingent.
Yeah.
Like there were actual problems today that you could go solve.
Yeah.
Like this isn't some fictitious, hypothetical, path dependent.
Yeah.
Like there's problems everywhere. And once you kind of, the light gets turned on for you as an entrepreneur, you start to see problems everywhere.
Yep.
That you could go ahead and be like and solve. It is really, really hard. And this is the thing I really took away from Domain Money the most, the previous startup. How hard it is to put a product out there and have somebody use it. You got the world's flooded with products. To get somebody's attention and have them use it is no small feat.
A lot
And
of
I find
noise.
that there's a mistake people sometimes make who have never done that. They're like, oh, maybe if I did this or I put up the site, like tons of people, like nobody's ever gonna care.
Yeah.
You don't realize how hard it is to get people to care about things. So for, first time founders or, repeat founders looking to raise money, like you gotta have like, what's the problem you're trying to solve? Why are you the person here to solve the problem?
Yeah.
Like founder product fit, founder market fit is one of the most important lenses that early stage investors will look like because they have no idea what they're going to be like. Is this a big market? Is this the right founder to attack the market? That's what they're placing the bet on because that product's most likely going to change after the pre-seed seed stage.
Yeah.
Like cultivating the network, getting your story straight. And, one of our investors, when we were going out to raise the seed round, was like, hey, you should pitch your tier 3 investors first, then your tier to get the story right. And, there's a certain element of, crafting the story, being really right. And you realize too, investors, they have limited information. You know more about the market than they do. And you could also tell by the quality of their questions, what's the likelihood that they're going to be your partner?
Yeah.
Like I talked to some investors, fintech investors, and they're like, so who buys bonds? I'm like, if this is where we're starting, it's going to be so hard for you to get there.
Yeah. What is ICE? Okay, cool. Well, I think the last question, and you did bring it up a little bit earlier, you talked about how AI is potentially a lever and automation writ large is a lever in kind of pulling more adoption into this market. Curious about how you're using tools today, whether you're using tools like a Cursor or Lovable, and even thinking about, hey, what could AI mean for how we build OpenYield as a business? Is it going to give you more leverage in terms of how you're building the product overall?
Yeah, so we've naturally been early adopters of anything AI out there that could assist with our workflows. The whole team's on GPT. When deep research was released a couple weeks ago, like we kind of went to town on it and quickly maxed out, but amazing research, like just blown away by the leverage it's given us on the business side. On the technology side, my co-founder has been pretty skeptical of the AI GPTs being able to like generate code that was at the production level for what we need as a marketplace with security concerns and all that. But we have this conversation literally every week about the newest tools, and he keeps testing them, and they're just about there where they could start doing a lot of the things that he needs them to do. It's great for like subroutines or, he take this, but we're writing our marketplace in C++ and Rust, and there's not as much of a robust library and like GitHub that these models have trained off of for the security needs that we need. So he's pretty cautious in adopting those tools. I think the more interesting conversation is around how can AI actually enhance our underlying core product. And this is what we're going to be transitioning into, and we're really excited about some of the products we're going to build, leveraging these tools going into the year. Because if you think about it, we have this live marketplace with tons of data coming in, orders and executions, reference data of bonds, And so much of the fixing world is around, people either gleaning narratives of what's happening in the market, which AI could really do good at now. And also in the bond space, there is always this back and forth between like, oh, is this bond similar to this bond, or I want to buy, this group of bonds, and in munis, like I want to do housing bonds in New York, and so there's a lot of natural language input and output that we could start to embed into our core protocol
Yep.
and take what used to be just QSIP matching and do much more interesting things.
Yep.
So, more to come on that, but we're really excited by the tools and the fact that, it's all just happening and we could adopt stuff pretty cheaply and embed it into our product.
Super cool. Well, Jonathan, thanks so much for coming by and chatting all things OpenYield. I really appreciate it. And we'll make sure we get this out to the people.
Desmond, thanks for having me. Great conversation.
Yeah.
Love the questions.
Thank-
Happy to do it again.
Thank you. Yeah, let's do it.